Have you ever wondered why some people seem to become millionaires through the stock market while others lose everything they've worked for? On paper, the stock market looks like a perfect place to grow your wealth. You invest in a company, the company grows, and so does your money, but the reality on the ground? Often far different. Many large companies maintain a shiny public image, sharing glowing performance reports, exciting future plans, and impressive revenue charts. Investors rush in, stocks rise. But what if the truth behind those doors is something else? Corruption, manipulation, and financial fraud are not uncommon. In fact, history has shown us time and again that when these dark secrets surface, the damage can be devastating. Investors lose billions, and the very foundation of the economy begins to shake. Let's rewind to 2008. The United States was hit by a financial earthquake. Banks were collapsing. People were losing their homes. Jobs disappeared overnight. The root cause? The housing bubble. Banks handed out risky loans, real estate prices soared artificially, and major financial institutions bet everything on assets that had no real value. When the bubble finally burst, the damage was catastrophic. Not in generations has Wall Street absorbed the number of body blows it took today, one reporter said. The American financial system, once considered unbreakable, cracked wide open. Institutions like Lehman Brothers fell under a mountain of bad debt. The government stepped in with billions of dollars in bailouts, money that came from taxpayers, not the people responsible for the crash. This was a wake-up call. For many people, it felt like the rules of the game were never fair in the first place. After the collapse, thousands of people took to the streets under the banner of Occupy Wall Street. Their message was clear: we are the 99%. The movement exposed the vast gap between the ultra-wealthy and the average citizen. People ask, why do big companies get bailed out for their mistakes while ordinary people are left to suffer? Why are the markets rigged in favor of a few? This frustration laid the foundation for something new, something radical. In 2009, just after the crisis, an anonymous figure named Satoshi Nakamoto released a white paper describing a new kind of money, Bitcoin. Bitcoin wasn't just a digital currency, it was an idea, a rebellion, a way to take financial power out of the hands of governments and central banks. Unlike traditional currency, Bitcoin is decentralized. No single authority controls it. No government can print more of it. Its supply is limited. It runs on blockchain technology, where every transaction is recorded publicly and permanently. This transparency and decentralization attracted people who were disillusioned with the traditional financial system. But here's the twist. While cryptocurrencies like Bitcoin promised freedom, many of the same issues from the traditional markets started to appear. In the world of crypto, we saw pump and dump schemes, fake coins promoted by influencers, major losses from hype-based investing. People created tokens out of thin air, hyped them up, and sold at the peak, leaving common investors holding worthless coins. Even though cryptocurrencies like Bitcoin are decentralized, human greed is still central. Whether it's stocks or tokens, the desire to get rich quick often leads to disaster. Many first-time investors believe the stock market or cryptocurrency is a guaranteed way to multiply wealth, but no market is truly safe. Behind every graph and growth curve, there's risk. Sometimes that risk is hidden, like in the 2008 housing crisis. Sometimes it's right in front of you, like a suspicious altcoin project promising 1000% returns overnight. No matter the platform, there are always people trying to play the system and play you. Insider trading is one of the darkest aspects of the stock market. People with secret knowledge about a company's performance trade stocks before the information becomes public. It's illegal, but it still happens. In decentralized systems like Bitcoin, insider trading becomes harder. Since no company controls the currency, there's no secret data to leak. The ledger is public. But even then, market manipulation exists in other ways, through massive whale investors or social media hype. One of the biggest mistakes people make is borrowing money to invest, thinking returns will cover their debt. But markets can crash without warning. When that happens, people not only lose their investments but also owe money they can't repay. History has shown how financial desperation leads to depression, family breakdowns, even suicide. If you're going to invest only what you can afford to lose. This is not a game for the desperate. It's a long-term journey of learning, patience, and awareness. So what should you do as an investor? Educate yourself. Understand the basics of any investment before you put in your money. Don't rely on hype. Diversify. Don't put all your money in one place. Spread your risks. Avoid emotional decisions. Fear and greed destroy more portfolios than bad investments. Verify information. Research every coin, stock, or project before investing. Have an emergency fund. Never invest all your savings. Life is unpredictable. We are entering a new era. Centralized systems are being challenged. Cryptocurrencies, DeFi platforms, and tokenized assets are gaining ground. But with freedom comes responsibility. Without central oversight, the burden of research, discipline, and risk falls entirely on you. Whether it's the stock market or cryptocurrency, every financial system has its flaws. But understanding those flaws is your first step toward building wealth safe. Don't chase trends. Don't fall for overnight success stories. Your journey as an investor should be slow, steady, and backed by knowledge. Don't aim to be lucky, aim to be smart. And above all, never invest in anything you don't understand.